There is a specific psychological comfort in holding your wealth, a visceral desire to pull your money off digital screens and lock it into heavy materials you can actually feel. Take Marcus. He buys physical gold bars because he trusts the vault. He sees the heavy steel doors and the white-gloved security, and he believes he holds the ultimate untouchable hedge against a crisis. Then there's Jake. He puts his cash into a pristine suburban rental property. He trusts the roof, the land, and the equity, completely convinced he just secured his financial future with the safest asset available. Digital numbers on a brokerage account feel fragile. We are evolutionarily wired to believe that if we can physically touch something, it can't suddenly disappear overnight. But their specific motivations split. Marcus is reacting to a deep fear of a total systemic collapse. Jake, meanwhile, is chasing the highly visible social status of being a landlord. By letting primal psychology and status dictate their purchases, both investors walk into a trap. They blindly accept the shared label of safe haven, completely ignoring the drastic differences in what these assets will actually demand from them. Open any social media feed, and real estate is relentlessly marketed with two words: passive income. The pitch is that you buy the house, sit back, and simply collect the rent checks. Switch the channel, and gold is pitched with equal certainty. It is sold as a guaranteed wealth preserver, an automatic shield that protects your purchasing power from inflation and market crashes. If you have a lump sum of capital to invest, you're paralyzed. You are trying to choose between a physical metal and a physical building based on identical marketing slogans rather than mechanical realities. To make an actual decision, we have to strip away the words passive and guaranteed. We need to expose the harsh mathematical and time-based costs required to hold these assets. Treating a rental property and a vault of gold as identical safe havens is dangerous. Their underlying financial engines run in completely opposite directions. Let's start with Marcus's vault. A profitable business pays dividends. A government bond pays interest. A physical gold bar sits in the dark and produces exactly zero yield. This zero yield reality creates a massive historical blind spot. Look at the data. If Marcus bought in 1980, he watched his supposedly guaranteed preserver slowly bleed value for 25 straight years. During that exact same quarter-century window, standard index funds were climbing steadily. Holding gold meant missing out on decades of compounding growth. But let's say Marcus holds on until a real crisis hits, and he finally needs his safe haven cash. He goes to liquidate his bars. The IRS does not treat his gold like a standard stock. Physical gold is classified as a collectible. The moment he sells, he is hit with a staggering 28% tax rate on his gains. Gold resists generating wealth while you hold it, and it heavily penalizes you with taxes the exact moment you try to use it. Across town, Jake faces his own reality check. His tenant just sent the first rent payment, but Jake doesn't get to keep it. Right off the top, 1 to 2% of the property's total value is consumed every year by basic maintenance. Then property taxes fluctuate. Then a tenant moves out, and the house sits completely empty for 2 months. His cash flow is decimated. Yet real estate still creates immense wealth. It just doesn't happen through passive rent. Look at his mortgage. Jake put down $50,000, but the bank allowed him to control a $250,000 asset. As the property appreciates normally, Jake captures all the gains on the bank's money. His initial $50,000 sliver multiplies into over $400,000 in pure equity. This exponential growth has a strict condition attached. The bank only provides that leverage if Jake agrees to actively manage the operational liabilities of a decaying physical structure and the unpredictable humans living inside it. Real estate is never a passive stream of money. It is a highly leveraged part-time business that demands continuous labor to keep the debt from crushing you. Stop comparing these two assets side by side. You have to stop asking which one is safer and start defining the exact job you need them to do. Gold is armor. An insurance policy is a sunk cost designed to protect you from total systemic ruin. It is not a vehicle built to move you forward. Real estate is an engine. It is a heavy, powerful machine built for aggressive momentum. But engines require constant fuel, routine maintenance, and a dedicated operator to run without breaking down. Investors fail when they buy armor and expect it to generate aggressive growth. or when they buy an engine and expect it to sit quietly in the garage and maintain itself. Let's map out your exact strategy. Your decision rests entirely on balancing your available time against your need for capital growth. If your priority is absolute insurance against financial disaster and you completely refuse to take on a second job, you must choose gold. You secure peace of mind, but the trade-off is harsh: zero yield while holding and a 28% tax hit when selling. If your goal is aggressive net worth expansion and you're willing to deal with broken pipes and tenants, you must choose real estate. You gain the immense mathematical advantage of 5-to-1 leverage, but the trade-off is abandoning the fantasy of passive income forever. True safety in tangible investing doesn't come from the physical weight of the material. It comes from perfectly aligning the mechanical reality of the asset with the reality of your daily life.